credit together. We're in
free credit, so I'll take the latest.
Okay, awesome. Thank you.
Hi, the announcer. Wait until it's 10:30 and just try to get their attention, otherwise they'll just ignore you.
How are you doing? Making announcements now?
Yes.
Awesome. For what?
For day of service next Friday.
Oh, great. Okay, good.
I'm catch my breath.
I ran here.
I was just not feeling my Latin version this morning. I'm trying to bike up.
I don't know what happened.
Good morning, class. So we actually have a couple announcements today, but first off, next Friday is the SGov-sponsored Day of Service. So I just wanted to encourage everybody to sign up for a volunteer activity that day. And then that night, of course, there's lots of happy hours for all the different student groups before preview weekend. But Day of Service, you can volunteer with the Bowery Mission either to make the sandwiches, to pass out food. You can come up with me to Harlem and volunteer at Harlem Grown and do some gardening. Or there's a park cleanup. So whatever you feel like doing next Friday, just encourage you to sign up for one of those.
Hi, everyone. My name is Natalie Samarco. I am co-president of the Emerging Markets Association. EMA and SEA are sponsoring a lunch on Monday, and this will bring together a former EVP of MasterCard and an NYU professor, Professor Schilling. They will talk about financial inclusion and also the financial innovations that allow that to happen. So we have the social side of things, and we have fintech. Lunch is provided. So Monday, lunchtime, 265, I will send the campus group's invite to the group. Thanks.
So thank you for sending in the cases. I was watching them come in, 10:27, 10:20. You guys cut it really close. Okay? And some of you sent in 3 versions of the cases between midnight and today. This is the right version, this is the right. Thank God Google threads your emails, otherwise I'd be going crazy. So it's, now, the way this will work is I will probably start grading them this evening. And I forgot to mention this when you sent in the cases, but I hope you carbon copied everybody in the group, because what I do is I reply all, and basically then everybody in the group gets the graded case. So basically your grade will actually be in your PDF file. So it'll be in the form of, on the very front page, there'll be a box that says, now this is your grade. And below it, there'll be these strange codes that say 9A, 9B, 10C. And what it will come with is a grading sheet that tells you what each, so rather than write the same thing, this is what I found in your case, it's really coded from 1 to 10. And if you get all 10 wrong, your score goes to 0, so nobody gets that. So basically it'll tell you this is where you lost a half a point, and it's so it'll be embedded in the case, and you should be starting to get it very soon, sooner than you think. Like I'll return it in the order that I got it. So the very first people who sent in the case, probably by 5 o'clock today, will start to see the graded cases, and the later you sent it in, the more I'll work it. And if you put the wrong subject in there, then I'll have to dig for it. So basically, so if you don't get your case back by midday tomorrow, it's probably because you didn't put the right subject, and I have to go to the regular. I won't give you a 0. I'm not that cruel, but it'll just mean that you'll have to wait till the end. Right? So before I show you my numbers, one thing I want you to do is not freak out. Okay? What I mean by that is I asked you to send your numbers in, right? Or I think about 50 groups kind of sent in those case summaries. I put them together, I checked the numbers, and I'll tell you up front, there aren't any two groups which had exactly the same numbers. Right? And none of your numbers match mine. So if I were grading purely on, if your number doesn't match mine, you're wrong, then the grading is going to be very easy. Net present values don't match, 0, 0, 0, 0. I'm not going to grade that way. So what I'm going to give you is my perspective on the case, but what I hope you get out of this is not so much what I say about the case, but broader lessons about valuation and capital budgeting in general, because I want to emphasize some points that this case I can use as a vehicle to talk about. So the first thing I want to talk about is the thorny issue of time. Let me explain what I mean by that. When you think about a real business operating and you look at revenues and earnings and expenses, they occur over time, right? You get revenues on January 1st, January 2nd, all through the year. So in the real world, everything happens in continuous time. There are some expenses like tax expenses maybe or lease expenses that might be discrete, because you make tax expenses once every quarter, you might make debt payments and lease expenses once every month, but much of what you see as operations happens over the course of the year. You're saying, so what? Accounting time works in fiscal years. So when you look at the most recent fiscal statement for Home Depot, it might be December 31st of 2016, or it could be September 30th, depending on the fiscal year. When you do analysis, you work in discrete time starting today, because your decision has to be as of right now. So when you say time 0, it's not January 1st of 2017, it is today, which kind of creates this awkward mismatch, right? Because your accounting numbers come from December 31st, but you have to make the decision as of today. So time 0 is today. Time 1 is exactly 365 days from now. So this is very messy, because in the real world, cash flows come in every year. You're putting this time 1, time 2. So when in your cash flows, we don't even think about it. What we call time 1 is exactly 1 year from today. It's not the end of 2017. It's actually 1 year from today. Don't worry, this is not messing up your net present value. This is just generally an issue anytime you do valuation. So we play this awkward game of making assumptions. We act like all our revenues happen on one day, on December 31st, or the 365 days from today. And when we discount back, so you might not even have thought about it, but implicitly when you did your DCF, you were effectively acting like the first cash flow happens 1 year from today. The second cash flow happens 2 years from today. Now you see why wherever you have this beginning of the year, end of the year, there's a timing issue. Because when something happens at the end of the year, that's exactly how we do present value, year 1, year 2. But if something happens at the beginning of year 2, in your timing, that's almost the same as the end of year 1, right? Because there's really no difference. So that's why when we talk about beginning of the year, end of the year, you can see cash flows moving. In this case, it wasn't a big issue. The only item where this became an issue was in that working capital. We might have to move. But other than that, most of the cash flows, you made implicit assumptions and moved on. Now, in practice, there are some people who really get caught up in this issue of, hey, things happen over the year. Why are we doing it at the end of the year? So what they often do is what's called a mid-year convention. You know what they do basically? They say, instead of saying everything happens at the end of the year, why don't we take the middle of the year? I have never, ever done a valuation of the mid-year convention, and here's why. Let's assume that all you've done in your capital budgeting is move time from 1 to 0.5. So basically, all that will mean is when you do discounting, you'll do 0.5 years, 1.5, 2.5, rather than 1, 2, 3. Let's say you have a project that looks like a bad project when you do conventional analysis, year 1. And it becomes a good project, at least in terms of net present value, because you go to half-year conventions. My question is, do you really want to take this project? If it's that sensitive to shifting things by half a year, is it really a good project, or is it just a zero net present value project? It isn't worth the time or the effort, from my perspective, of doing things on a half-year convention. Doesn't mean you shouldn't do it, but if you do it, it's not going to make that gigantic change in whatever your net present value is. So I'm going to summarize what I found in this case, and part of what I found is going to be very similar to part of what many of you found, and I'll show you your results. But one part of what I found you're going to find is in variance with what you found. So let me go through what I found. First, The cost of capital I ended up with for this project was 10.13%. To get that cost of capital, I came up with a beta for the project. The debt ratio I said is going to be the debt ratio for the company. I'll take you through the details. But for this project, the cost of capital is 10.13. This is not Home Depot, the company's cost of capital. This is Home Depot Furniture's cost of capital, 10.13%. From an accounting return perspective, the returns I get vary from 14 to 18%, depending on whether you started the year, end of the year, accounting judgments, but somewhere around 15, 16%. So if I stop right there, project looks good. Return on capital exceeds the cost of capital. When I did the net present value with a finite life, the 15-year life, the net present value that I got, ignoring the side effects, because remember this project creates two side effects, one positive and one negative. Ignoring the side effects, I got a positive net present value of 109 million. And if I extend the life, I get 123 million. This is where almost every group, and you can look at the difference between what I found and what you found is going to be huge. And we're going to talk a little bit about why there's so little impact. Because it looks like extending the life, in my case, is not doing much to the net present value. This is a pretty neutral project. 109 million, it's not a huge net present value. Given the investment, it stays a pretty neutral project when I extend the life. And I want to talk a little bit about why that's happening with my analysis and might not be happening with yours. The side effects here, there are two. One is, remember those stores they take over and make into furniture stores? I lose sales on those stores that I otherwise would have had. That's a negative effect. There is a positive effect, which is increased sales at other stores. This is, if you didn't do this, it's not a big deal, but it's something to think about. These are cash flows to the regular business. So to discount these cash flows, rather than bring them into my full cash flows, I kept them separate and I discounted them back at the cost of capital for Home Depot's building retail, their regular business. In this case, it makes such a little difference because the numbers are so small relative to big cash flows that if you brought them all into your overall cash flows and discounted at the Home Depot cost of capital, it doesn't make a difference. But this is something worth thinking about whenever you have cash flows coming from another business and they're large enough, you might want to separate them and discount them at a different rate. I would reject this project, okay, which actually puts me in the minority because 1 in 4 groups suggested rejection. In this class. I think it was 15 out of 50 groups suggested rejection. I would suggest rejecting this project because on an aggregate basis, the net present value becomes negative. Incorporating the effect of these side effects, I get minus 274 million in my finite life case and minus 213 million in my longer life case as my overall net. So my net present values are negative in both cases. So let me kind of launch into the numbers and we'll talk a little bit about why there might be differences across groups. So here are my cost of capital computations. To get the cost of capital, I started with the firms in the furniture business where I gave you that sampling of other firms in the furniture business. Their median regression beta I came up with was 1.26. Their median debt to equity was 13.71%. So I unlevered the beta, cleaned up for cash. My unlevered beta, corrected for cash for the furniture business, was about 1.26. Now here's why some groups, I was checking through the groups that got 8, 9%, and I think there's a variance in cost of capital. One reason for that variance is how you computed the unlevered beta. Some of you actually did an unlevered beta for each company and took a median. That's perfectly okay. You'll end up with about 9% cost of capital. And that's why I said when you get differences, some of those differences are estimation choices. Some of those differences are concepts. So separate those estimation differences you have from the conceptual differences because the estimation differences are going to be there no matter what. So that does make a difference because it lowers your cost of capital. I prefer to average first and then unlever for a very simple reason. Some of those debt to equity ratios are outlandish, right? There's a 225% and a 228%. If you take the regression betas for those companies and unlever at that huge debt to equity ratio, their unlevered betas go to 0.3, 0.4, which I think is an effect of more of the noise in the debt to equity ratio than a true unlevered beta. But as I said, that's just an estimation choice. I use the average beta, unlevered using the median beta, unlevered using the median debt to equity, cleaned up with the median cash. So that's my unlevered beta. To lever that beta, I had to compute Home Depot's debt. And there are two types of debt that they have, right? Interest-bearing debt, which I estimated to be worth about $22.67 billion. And to compute the interest-bearing debt, I took the book debt and I looked. I basically did what I did for Disney. It's really, if you use book debt, it's not, you get pretty close to the same number, 21, 22 billion. Just be careful not to load up the debt by adding up all that other stuff on the balance sheet. Like non-current, you feel the urge to do it, don't do it. Right? Non-current liabilities are not really debt until you know what they are. If you add them on, you might say, I'm being conservative, but you're actually pushing your cost of capital down. So I have 22 billion in interest-bearing debt. The other debt, of course, is the lease commitments, right? And I took the present value, and here I was looking through, and there are variations in how people computed that. I assume that and this is where the accounting versus the real time comes in, right? Because what I gave you were lease commitments from the end of December 31st, 2016. So the very first lease payment, the lease commitment that you have, is actually happening at the end of 2017. So some of you treated that as year zero. So basically you took the first lease commitment as being right now, and that's fine. You get a higher present value than I do. I basically assumed that that first payment was far enough, it's 9 months away anyway, to be close enough to year one. So you should never do is count last year's lease payment. That is is no longer even in the game. That's gone. It's only future commitments that you'll be discounting. And my present value for the lease commitments was 5.73 billion. The other difference that caused differences in present value is what I did with that lump sum, 3,574 million at the end of year 5. Some of you spread it out over 3 years, some over 5. I spread it over 6 years. The more time you spread it out over, the less your present value is. The reason I spread it out over 6 years is if you look at roughly what the lease commitment is for the next 5 years, it's about 500 to 550 million. And the 6 years gave me that amount. But again, if you made 3 years, no, we don't know. So that's again an estimation choice. It'll give you a higher debt number. Based on that, my debt to equity ratio was about 16%. The levered beta that I get with that debt to equity ratio is 1.38. That was the beta that I used to come up with the cost of equity of the Home Depot furniture business. The risk-free rate is 2.5% because that was given. The equity risk premium, though, comes from where this project is going to get its revenues. And if you look at the breakdown that was given in the case, it's about 90 stores in the US. In fact, I was looking over the calculation. Some of you ignored the 50 old stores, but remember, they're part of the project too, right? So if you ignore them, you get a higher equity risk premium. This again, no, if you did it, I can understand you overlooked the fact of the 50 old stores. But those are part of the project. You have 90 stores in the US, which gives you about 60% of this project being in the US, and the rest spread out over the rest of the world. The weighted average equity risk premium that you get based on where the stores are going to be is 6.43%. I think you get 6.8% if you look at only the new stores, which again is not going to, that's why some of you ended up with cost of capital of 10.5, 10.6%, is if you use the higher equity risk premium, it pushes up your cost of equity and capital. So my cost of equity for Home Depot furniture is 11.38%, using the risk-free rate, the beta, and the equity risk premium. Any questions up to there? For the cost of debt, you were given the default spread, the rating and the default spread, 1.5%. Add that to the risk-free rate, I get a cost of debt of 4%. I said continue to use a marginal tax rate of 40%. That gives you an after-tax cost of debt of 2.4%. Weighted by debt and equity, my cost of capital for the Home Depot furniture cash flows is 10.13%. Yes? It's a coupon. I'm doing exactly what I did for Disney. As I said, it's not a big deal here. The book value of debt is so close to the market value of debt that if you didn't do this, it doesn't make much of a difference. I just do it because I do it every time I do debt. Otherwise I get into bad habits. Yeah.
Actually, we found there were capital lease.
Yeah, that's included too in the 22.8 billion. So that does include the capital leases. Because once you capitalize leases, here's the rule for debt. If there's an interest expense in your income statement that goes with an item in the balance sheet, then it's debt. When you capitalize leases, there is an imputed interest expense that gets added to your interest expense. So my rule with debt is, if there's an interest expense on my income statement that reflects that debt, I'm going to count it as debt. But if you have an underfunded pension obligation, I'm not going to count it as debt because there is no interest expense. Accounts payable, I'm not going to treat as debt because there's no explicit interest expense. So I did include the capital leases as part of my debt too. Right? Yes?
Why do you exclude the additional little more revenue to the U.S.?
You could. Yeah, you're saying why not bring the synergy revenues? You could. In which case it'll push down.
Systematically treat
No,
those differently.
no. So in fact, if you can, did everybody get the point, which is remember the side benefits and the side costs. If you want to bring them into the equity risk premium, it's going to shift it a little more towards. No, in this case it's small, but you're right. If half my revenues came from synergy and my existing U.S. stores, that'll tilt my equity. Then I would have been a little more careful about bringing it in here. It was so small I didn't even bother. And it nets out actually, right? One is a minus, the other is a plus, right? So there's positive, and so it actually, if you net the two out, you actually end up with less stuff coming from the US, because you can't just count the good stuff, you also have to count the lost sales then, right? So the net effect is actually a little tweaky. It's tough to bring in. So I kind of, tweaky, is that the right word? No, whatever, you kind of get what I'm saying. So that's my cost of capital for the Home Depot furniture store is 10.13%. To get the cost of capital for Home Depot building retail, I started with the levered beta from the regression. I don't like to do it, but since I haven't been given building retail comparables, I start with the levered beta. It's already levered, so I'm going to assume it's been levered right. So 1.08, I think the case said assume it's a correct levered beta. I use that as my beta. My risk premium, though, is 5.69% because I said assume that all of the building retail stores are in mature markets. So basically, I could use the 5.69%. Lower cost of equity, same debt ratio and cost of debt. My cost of capital that I'm going to use, and this will get used only for the side benefits, which are U.S. building retail stores, is 7.78%. As I said, in this particular case, if you did not take that extra step, it's not a game breaker or game changer, simply because the numbers are so small. But this is something worth thinking about. If 30% of your cash flows were coming from those side benefits and costs, this can make a big difference because that's a much lower discount rate you'd be applying on those cash flows. So I looked at your cost of capital. I put up a distribution. So here's what your cost of capital look like, right? So about 20% of the groups ended up with cost of capital above 10.5%. There were 3 groups which ended up with cost of capital below 8.5%. Obviously, I haven't looked at every single case, so until I look at the cases, I don't know why they're really low costing. What I hope you haven't done is used Home Depot's beta in your furniture cost of capital. I mean, we went over this again and again, because that's what's going to give you a really, really low cost of capital. It's going to cause the project net present value to explode. So if the differences are because of how you computed unlevered beta or tweaks about how you did lease commitments, it's within the estimation range. And I think the estimation range should put you here within 1% of my estimate. But if it's below or above that, then the question is, what have you brought into your cost of capital that doesn't belong there when you talk about discounting the cash flows? So that's my discount rate part. Let's get to the more interesting side of this case. Now, before I get, let's stay in the less interesting side still and do the accounting return on capital. I computed the accounting return on capital. You know how much role it played in my final decision? Less than nothing. I did it just because I asked myself to do it, right? So I had to do it. So I did the operating income. And the reason I got quite a few questions about, because when you do accounting return on capital, you get stumped on things like, what should I allocate to this case? What should I not allocate? The kinds of accounting things that suck up time. And my response is, if it's not going to make a big difference in your decision, just make an assumption and move on. So whenever I had to, when I had to do the return on capital, I did allocation decisions. I frankly didn't spend more than a second or two on them. Because ultimately I knew at the end of the process, I wasn't going to use the accounting return on capital. But with my numbers, I ended up with the return on capital, which built up over time. And the average I got across the 15 years was about 16.15%. Without counting synergy. With the synergy, it was a little higher. It was about 18.44%. But let's look at the distribution you got. When you looked at your accounting returns on capital, I think the middle of the distribution for across your groups is about, pretty close to mine, 14 to 16. But you can see the spread. There were some groups that got returns on capital above 20%, partly because your invested capital was usually getting written down faster. And there were other groups that were loading up things into the invested capital. And here on this one, I'm not even going to be quite honest, I'm going to look at your returns on capital. And if you did not base your decision on return on capital, I'm not going to sit there and second guess you on what you put in, what you did not put in. So it's how much time I spend on your return on capital table is going to be in direct correlation with how much you talk about return on capital in your final decision. So this one, the differences usually are accounting judgments causing the returns on capital to be different. So let's talk about cash flows, because this is where I think the action is in this project. I separated the analysis into two parts, my finite life case and my perpetual life case. Let's start with the finite life case, because here I think we're going to see a lot of agreement across what I'm doing and what many of the groups did. So I took the revenues, the operating income, etc. And it's a little involved. You have to build a spreadsheet, you have old stores, you have new stores, you're opening new stores. So basically you got to have multiple lines, build it up. It's really an exercise in model building. Okay. But here were the items I specifically did separate from that model building. There is these old stores, right? And they have a book value. And there is depreciation that's going to happen on those old stores. Just given in the case. Now I can build the depreciation into my cash flows, but remember that ultimately what cash flows do I want? I want incremental cash flows. And the reality is this book value is going to get depreciated whether I take this project or not. It's just going to be depreciated by a different division. So I didn't even bother with the depreciation on the old stores simply because I knew I was going to take it out anyway. So why mess up my cash flows by bringing it in and taking it out? So I just ignored the incremental depreciation. One load off so I didn't have that 50 million in year 1, year 2. If you did it and then corrected for it, it ends up with the same effect. So we end up with the same cash flows, but I skipped that step. On the distribution system, and I thought I gave away too many hints on this, but as I was looking at the cash flows, maybe the hints didn't stick. We talked about the cost of using excess capacity. And in this particular case, I make it very specific as to what happens when you run out of capacity. I said you have to build new capacity. So you're using excess capacity on the Home Depot furniture division. It's excess capacity right now. But by using it, you're actually going to run out of capacity in year 5 instead of year 12. It can be year 6 and 13 if you did it based on the year you... So I actually was investing the year before you fully ran out of capacity, saying I've got to invest before I run out of capacity, not... But if you did 6 and 13... But basically, you run out of capacity in year 5 because of this case. But remember, to answer the incremental question, you also have to ask what will happen if I don't take this project. And if you don't take this project, given how much capacity usage is growing, you're going to run out of capacity anyway in year 12. So what's the incremental effect of this project? You're investing in year 5. So I saw many of you short of 550 million in year 5 or year 6. But by investing in year 5, what are you saving yourself from? Investing in year 12. To complete the process then, I show a negative cash flow in year 5, and you're going to see a positive cash flow in year 12, reflecting the fact that I can't just count the bad stuff and ignore the good stuff. I've just moved things around, which means my net present value effect is just going to be the difference between investing in year 5 versus year 12. Again, it's not a game changer, but something to think about, because it's the difference in net present values is much smaller than just taking the present value of investing in year 5. Of course, I also tied up the loose ends. There's depreciation that comes with it. So basically, I get depreciation. So I did the whole analysis saying I invested earlier rather than later. What's the present value impact of doing it? And I left it in the cash flows rather than doing the present value and bring it to initial investment, because why not just leave it in the cash flows and see how they play out? That is one of the things that probably causes net present values to be different. And finally, and this is again a place where I think we'll have disagreements, is we talked about capital maintenance, right? Why do you need capital maintenance? Because you want the project to keep going. I made perhaps an extreme assumption that if I'm going to shut the project down at the end of 15 years, I'm going to run this project right from the beginning knowing that's my plan. Remember, when we talk about perpetual life, you don't wake up on the last day of the 15th year and say, should we keep this project going or should we not? This is a decision you make up front, because the way you run this project right from the beginning is driven by that choice you make. There are probabilistic choices and deterministic choices. Probabilistic choices you don't control. Deterministic choices are choices you make, and the choice of whether it's a finite life or a perpetual life is not given by God, it's given by you, by how you run this project. So if I'm running the project as a finite life, why would I keep pumping in huge amounts of capital maintenance in year 5, year 6, and especially at the end of year 15? So if you have capital maintenance in year 15 in the finite life case, you know what you're doing? The day you're shutting down the project, you're investing $300 million in new assets. That you would never do that. So if you put in low capital maintenance in the finite life case, okay, that's fine. That's it's just a different version of my assumption. But I've assumed no capital maintenance, which effectively is going to mean that I have depreciation providing me cash flows, and I get to keep those cash flows. My working capital and store investments, I'm assuming, happen at the start of every year, so they're going to show up in those cash flows. So here's what my finite life cash flows look like. And here's what I mean about the distribution system. So basically, I was checking through, and I think most of our numbers match up. Revenues, operating expenses, the allocated expenses. But then I kind of clean up for the expenses that are non-incremental. But if you look at the depreciation system, that's the distribution system, in year 5, you see a capex of $552 million. So that reduces my cash flow. So that's why my cash flow in year 5 is negative. But in year 12, you see a negative amount. That's the savings of $634 million that I get in year 12, because I no longer have to invest. Don't look so gloomy. It's okay, you know. If this is all you missed, you're still absolutely okay. You're going to be half a point in this larger scheme of things. But whenever you think incremental, think through the whole process. Don't just think about the first step in the incremental. Say, what will happen if I... And that's why I kept saying, ask yourself what will happen if you take the project, what will happen if you don't, because that forces you to complete the process and think through the consequences. So those are my cash flows, and you can already see there are 2 sign changes, right? So I'll tell you how I did internal rate of return. Because I don't like to use the IRR function. I use the solver function in Excel. The solver function will do a much cleaner job for you because you solve for that discount rate that makes the net present value 0. If you have only one sign change, the 2 numbers will be the same. But this was a much more versatile way of doing it. So in this case, the cash flows do switch signs twice. Mildly in year 4. It's not going to be a huge issue, but you have to keep that in mind when you think about internal rate of return. At the end of 15 years, what do? I shut the project down. When I shut the project down, I have to sell whatever I can, right? I assumed, and I'll tell you why I made this assumption, I assumed that my assets get sold at book value. Why do you think I made that assumption? I could make any assumption I want. In fact, you could have assumed that the assets are worth nothing, but then I'm going to ask you a follow-up question. If you assume the assets are worth nothing, you have a loose end to tie up, right? Which is, the book value is $2 billion. You assume the assets are worth nothing. You're going to get a capital loss. I'm going to say, show me the tax. So the easiest assumption to make at the end of 15 years is to assume that you will sell at book value. And that includes not just your fixed assets, but also your working capital. You have a going out of business sale. That's basically what you're having. So that number at the end, 1.548, is the salvage value of all of the investments I've made over the 15 years. What's left of them? Yes? Capital gain. That's the reason I don't sell above book value, because then I have to pay a capital gain tax. So I'm okay with you assuming a salvage value other than book value. After all, I can't prove that it's wrong. Maybe you can make the argument that these stored things are going to be worth more or worth less, but then you got to tie the tax loose end of what are you going to do about the capital gain or capital loss of something. That's why you can never abandon assets and just show me a cash flow of 0 at the end of year 15. Because even if you abandon assets and get nothing, you're still going to get a tax savings from having abandoned those assets. Now, as I said, I kept the side effects separate. And there are 2 side effects. The first is, remember those old stores I took over and I lost income on those stores? I think it was $1 million per store. That's the minus $50 million that you see on the lost stores. But I do also get a benefit, which is increased sales at my stores. And so that's the revenues, the additional revenues. And actually the cash flows I get to keep from those additional revenues is just the margin. You don't keep the revenues, not your cash flow. So the reason you have the margin times the revenue gives me. So the net effect there is I actually lose cash flows on net. And that's what I meant about the equity risk premium shifting actually more away from the US when you bring these in. Is I actually get a negative effect for the first 10 years. And then the side benefits still continue, but my lost sales from stores stop. Those cash flows are the cash flows I'm going to discount at that much lower cost of capital. And you can see why it doesn't make much of a difference. Look at how small those cash flows are. So when I did my net present value, here's what I got. I discounted the incremental cash flows that I showed you at the 10.31% cost of capital. That's 109 million. I discounted the side costs and benefits which accrue to my building retail stores at 7.78%, and that gives me minus 274 million. You add those two numbers up, what you get as your overall net present value is minus 165 million. So my finite life net present value was a negative number. So here's what you found. 2/3 of you actually came to the same conclusion. Some of you had massively negative net present values. And I will guess that here's what you did. You invested like crazy in capital maintenance in your finite life case. If you do that, we know what's going to happen, right? Your cash flows are going to get negative. At the end of the 15 years, you're going to say the project is done. This is about as unfair as you can get to a finite life analysis, because you're acting like you're running the project forever. At the end of the 15th year, you say, oh, I've changed my mind. Of course the project is going to look awful. Your net present value is going to be a huge negative number. And about 1/3 of you did find the project to be positive, either because your cost of capital was lower than mine, 8.99%, you'd start to see the tipping point, or because you made some assumption on the cash flows. Maybe you didn't invest in the distribution system. Maybe you did something like allocate. Remember, these are cash flows. There's no such thing as allocation in cash flows. You either spend the money or you don't spend the money. But until I look at your cash flows, I won't know, especially with the bigger net present values. Any questions in the finite life case? Now let's talk about the perpetual life case. Yes?
With the distribution center,
Mm-hmm.
how do you deal with depreciation of the non...
Keep it simple, right? What I did was straight line depreciation. So basically what you do is act as if the old business, so if I invest in year 6, let's say use a 20, you can pick any period one. You want a 20-year life, depreciate straight line. So what you will get is incremental, so you'll spend more in year 6, but you'll also get more depreciation for those next 5 years. And then in year 12, the new asset would have kicked in. So basically the depreciation effect, though, is just the tax effect from depreciation. So you multiply the so it's just one extra line item that you have to bring into the cash flows that reflects the fact that spending earlier rather than later also brings a depreciation tax benefit. It doesn't change the numbers very much, and that's why if you ignore depreciation here, I'm going to let it go, because it's really not going to be a big impact, because it's a small enough present value effect. But that's what you would need to do, is pick a depreciation life, pick straight line depreciation, and start the depreciation going the year you invest. Okay? When I extended my finite life to an infinite life, the first thing I want to say is this is something I have to do right from the beginning. I mean, it's like saying, look, I want to be at my perfect weight at the age of 65. You can't wait till the last day of the 65th year and say, I'm 50 pounds overweight. I have to drop 50 pounds today. You can try, you've got to cut off a leg or cut off an arm or something. You might lose 50 pounds, but you'd lose it the wrong way. If you want to be at your right weight at the age of 65, you probably have to start exercising at 55 or 45 or 35. That's the way to think about a perpetual life case. If you want to run this project forever, you got to start it day one. You got to make decisions that reflect that choice. What does that mean? Well, you're going to be investing a lot more back into the project, because if you take all the cash flows from depreciation out of the project, you're essentially letting the project deplete. And coming at the end of the 15th year and starting capital maintenance is way too late, right? Because if you wait till the end of the 15th year and then say, okay, I'm going to start capital maintenance now, you've already let the assets deplete to a point where you're maintaining depleted assets. So I start capital maintenance right off the top. You're saying, how do I know how much to put back? Well, you know how much you took out, right? The depreciation is what you took out. Roughly speaking, if you don't put that back, and I use the example of, depreciation is like calories burnt off. Maybe I haven't used that here. No. CapEx is like calories consumed. If you think about that analogy, basically I have to start to be consuming as many calories as I deplete. So I use depreciation as my measuring rod, and I actually let CapEx exceed depreciation by the inflation rate. And here's why I do that. When you replace old assets, if there's inflation, you're not going to be able to replace at the old cost, so I'm setting the CapEx above depreciation. And once I get to forever, this is not even an option. You have to set CapEx at or above depreciation, because if you don't, you got an impossible cash flow. You see why? Because if you let the depreciation continue after year 15 with no capex continuing, there's going to be nothing left to depreciate, so there will be no forever in the depreciation number. So it's going to show up in two places. And everything else continues. There'll be no salvage here because I can't salvage the assets at the end of year 15 and allow the project to go. So I'm going to replace the salvage value with essentially a terminal value. So if you look at what happens with the infinite life case, what you will see as the difference is now you have a capital maintenance expenditure that is now increasing over time just to keep my project going. My cash flows reflect that increased capital maintenance. And my terminal value now is 6. Do you remember what the salvage value was? It was like 1.5 something billion. No, let's see what it was. 1.548. Hey, here's the good news. The terminal value is much higher because it's a going project. The bad news is, to get to that terminal value, I had to reinvest a lot more over the next 15 years. Okay. That terminal value calculation is what I've captured here. Basically, to get the terminal value, I get the cash flow in year 16, because you always need a cash flow 1 year after your last year. You divide by your cost of capital minus your growth rate. Your terminal value of 6,584 is basically the value. I set my growth rate at the inflation rate. And I'll explain in a minute why that is, again, the safest thing to do. Because if you set it above the inflation rate, you can do it, but then you have a lot of other catching up to do because you're letting the project grow in real terms. So just to show you the contrast between the two cases, what I did was I took my cash flows in the finite life case and I have my cash flows in the infinite life case. And here's what the differential cash flow is in the last column. So by moving from a finite life to a perpetual life, here's what I do. I give up cash flows over the next 15 years. Why? Because I've got to put money back into the project. And I get a terminal value that is much higher. With my assumptions, the net effect of that last column is what causes the present values to be different. And that net effect is close to zero. Okay? And to be honest, I would be very surprised if you took a project that's a neutral project over a 15-year life, which is what you have. And by just extending the life, you magically could add 2 billion to the value. Every project would be extended forever, right? There's a reason why some projects, or many projects, or most projects have finite lives, because extending the life is not magically going to increase your net present value. The reason it's increasing your net present value is if you don't count in that negative stuff for the next 15 years and just put in a bigger terminal value. Of course your net present value is going to go up. It's almost a given. But it's not that easy. That's why you need to bring in assumptions that are consistent with a perpetual life case. Yes?
The maintenance capex, would it make sense, or would it also make sense, the total new invested capital plus additional maintenance equals to the annual depreciation? Then
Total initial investment plus annual maintenance. No, you don't want to bring in the total investment, right? The total investment is like 3 billion.
Not total, like annual new investment plus maintenance equals to annual depreciation.
You could. So basically in the early years then you'll have less depreciation. That's fine. I mean, as I said, on this one it's not a question of did you make the same assumptions that I did. The question I'm going to ask is, are your capital maintenance assumptions different in the two lives? That's all I'm looking for. So if you have less capital maintenance in the finite life case than in the perpetual case, I'm going to say, okay. Now, we're thinking on the same lines. You might have made different. I use zero and depreciation as capital maintenance. You might have said in the finite life case, capital maintenance is 20% of depreciation. But in the perpetual life case, it's 90% of depreciation. It's got to be at least 100% at some point. Okay, so we're on the same page. We're just using different metrics. Yes? Well, if that is the case, though, I would expect you to have to invest more up front if you want to do a perpetual life then. So if you said, look, I want to build a power plant that is a 15-year life, the kind of power plant you're going to build is going to be less expensive than if you're a Con Ed and you say, I want to build a power plant that potentially covers me for the next 100 years, right? So that's what I'm saying. Even the initial investment, the way you do it can be different. because otherwise every company will make a 15-year investment and halfway through, so let's make it in a perpetual, just put a terminal value. You can do that in a spreadsheet, but I'm saying in a business, the choices you make right from the beginning, in this case, before you even make your initial investment, will be determined for, hey, do I want to cover the next 15 years of needs or the next 100 years of needs? And that's the trade-off you have to make up front for this to actually play out. Any other questions? So my net present value, not surprisingly, doesn't change very much because my cash flows are more negative for the next 15 years. My terminal value is much bigger. They kind of offset each other. My net present value stays negative for both before the side benefits and side costs. In fact, it gets a little, it goes up by about 14 million, 109 to 123, but my overall net present value stays negative. So I want to kind of emphasize this point because you're going to run into this in valuations all the time. You know how you're going to run into this? You have to value a company. And in a company, what do we routinely make? We routinely assume that you get to year 5 or 10, the company keeps going forever, right? We use that terminal value equation, just like we did for the project. If there's one lesson I hope you take out of this case, it's when you sit down to value a company and you start projecting out capital expenditures for a company, make sure those capital expenditures are compatible with what you're assuming happens after your 5th or your 10th year. Because here are your choices. If you assume the project, if the company is going to be liquidated after 15 years, a royalty trust, 15 years you're done, you're not going to be putting capital expenditures in. You're essentially going to run the project into the ground, you're done. So if you say there's no or very low capital maintenance, that's completely consistent with you saying this is a finite life project. If you tell me that this project has an infinite life, and the growth rate is going to be 0, so it's not even the inflation rate, the growth rate is going to be 0, you can actually set capex equal to depreciation and get away with it because capex equals depreciation means your invested capital stays frozen and your operating income stays frozen, your return on capital is stable, everything's okay. If you set the growth rate at the inflation rate, your capex has to be higher than your depreciation. Why? Because you're counting the good stuff in your, inflation, I'm going to push up prices. You can't just count the good stuff in your revenues, you've got to count it in your capital expenditures. And now comes the case which we often use in traditional valuation. We assume that companies grow not just at the inflation rate, but at more than the inflation rate. And once you do that, you can't just put in enough capex to cover your depreciation. What do you have to invest in? More capacity. You're making the company bigger. Your capital expenditures have to be significantly larger than the depreciation if you assume growth forever, and that is real growth. You'll be surprised how many discounted cash flow valuations of companies I see where you get to the terminal value stage. You'll see the company continuing to grow at 3% a year forever, and the analysts will assume depreciation equals capex because it's a mature company. That's not going to work. If you put in a 0 growth rate, it'll work, but if you have real growth, you have to reinvest to create that real growth. So here's what you found in the infinite life. Remember, 2/3 of you had negative net present values with the finite life? So even without looking at your cases, I know that your perpetual life, your capital maintenance expenditure is not different enough to in fact, on average, your net present values climb by about 2.115 billion. So I took the difference between the two net present values you said, when you went from a finite life to a perpetual life. And that is exactly what you will expect to see. If all you've changed in your cash flows is instead of a salvage value, replace. In fact, in my analyses, if I just take my finite life case of 1.548 billion, replaced with a $6.5 billion terminal value, and all my other cash flows stay the same, of course my perpetual life is going to have a much big, about $2 billion higher net present value, because I am counting the good stuff then that comes from perpetual life and not the bad stuff. So here's what the 50 groups that sent in their numbers yesterday told me. 15 of you said it should be rejected. Even though, and many of you did that in spite of your fact that your perpetual life, you said, no, you said even though, I haven't read what you said, but basically I'm sure even though net present value is positive, it's not positive enough in a finite life case, I'm being conservative. No. 30 groups suggested the investment should be made because the perpetual life case net present value was so high. 5 made conditional statements. which is, if this is a perpetual life project, take it. If it's a finite life, that's what I meant about this not being a probabilistic choice. This is a deterministic choice. And basically we're saying, if I want to run this project as a perpetual life project, I should take it. Just say it. Don't make this a conditional statement now, because I can see your net present values are negative in one case and positive in another. Don't hedge. When you have to make choices, make the choice. There are lots of uncertainties here, but ultimately you have to go 0-1. This is like weak buys, semi-strong buys in equity research reports. You either buy or sell. And keep that in mind when you either invest or you don't invest. You either accept or reject. Any questions on? Yeah, go ahead.
If you were to give this assignment to a group of 50 groups of corporate finance teams in the real world, would their answers be as diverse as ours, or would they converge to a single spot?
First, aren't we all in the real world? So, 50, I mean, you mean 50 experienced professionals? Is that what you're saying? Yes. In fact, they'll probably be more different because if some bad habits are so deeply embedded that they'll find their way into the analysis. They'll do things like add a small cap premium. Why? Because that's what we always do. Or they'll knock off 10% of the cash flows because that's what you'd be surprised how many bad habits get embedded into capital budgeting projects the more projects you do. So experience doesn't reduce the diversity. You know what will reduce the diversity is if I kept giving you more and more guidance. So on the leases, if I'd taken that big sum after year 6 and said it's 6 years, that reduces the diversity. If I'd said on the companies, I said use the average median first and then unlevered. But those are things I wanted to leave to you because I'm okay with you making choices on. So I actually pushed the net present values closer by giving you numbers that you probably would not have in a real case. Right? You might have revenues, but you'd have to estimate what the margins are and what the cost of goods are. So the divergence will actually be much bigger. Right? So now let's finish off our final pieces of investment analysis. There's one side cost I did not get to last session, and I'll explain what this is by using an example. Let's suppose you looked at the Disney theme park example. Remember, I took revenues, subtracted expenses, came up with cash flows, came up with a net present value that's positive. Let's suppose I forgot to mention something until now. And here's what I forgot to mention. That 20% of the people who are coming to Rio Disney would have gone to another Disney theme park anyway. You see what I'm saying? The Rio Disney was not bought. They'd have flown to Anaheim or they'd have flown to Orlando. By building Rio Disney, they're coming to Rio instead of going to Orlando. So if I applied a strict incremental test, what will happen if I take the project? What will happen if I don't take the project? What should I do to this 20%? I should take it out of the revenue saying, hey, you know what? I'd have got that anyway. Why am I counting those revenues when I would have got them anyway? This is what's called product cannibalization. When a company introduces a new product, like the iPhone 8. What percent of people who buy the iPhone 8 would have bought the iPhone 7? This is like massive cannibalization, right? If I take it out of the revenues or think through the consequence, I'm much less likely to build this theme park, right? And if I'm much less likely to build the theme park, the worry I might have is what if why are these people coming to the Rio theme park instead of going to Orlando? Because they live 50 miles away, 100. This is more convenient. And I'm saying, look, they're going to come anyway. If I'm absolutely sure that those people are going to come to my theme park anyway, of course I should take the 20% out. Because then, those are my revenues anyway. But if I'm worried about Universal building a theme park in Rio, and these people saying, I'd rather go to Disney, but this is so convenient, I'll go to the Universal instead. And there's an argument that 20%, even though you'd have got it anyway, just leave it in the cash flows. I wonder how Starbucks does capital budgeting on an individual Starbucks. Do you see why I'm asking that question? It's like watching, some virus explode on you. Starbucks, there's Starbucks, there's Starbucks over there. You open a Starbucks on 8th Street, you're one on 6th Street. I wager a third of the people coming to the Starbucks saying, I don't want to walk 2 blocks, this is half a block away from me, this is more convenient. If you used only incremental cash flows at Starbucks, my guess is half these stores will not be open. And that's actually not a great sign of health for a retailer if you keep consuming your own customers by just opening new stores. Okay? There's no easy answer. It really depends on whether you believe that these people who come into your Starbucks or Disney theme park would have come in anyway. And if you feel they'd have come in anyway, then you take it out. But if you feel that a competitor opening a store there will draw your customers away, then you leave it in. That's why when you're a smartphone company, when you introduce a new phone, you shouldn't be just saying, well, 80% of the people that have bought my iPhone 7, so I'm going to count only the 20%. You'll never do an upgrade if you did that. Okay? And you can see, if I'd asked the same question about a new show that Disney was coming up with that is drawing people from another show, there you're less likely to take the revenues out of your total revenues because you'd say, well, I didn't do this, somebody else will do this to me. It's better to cannibalize your own sales and have a competitor cannibalize your sales, right? So there's no clean answer to either question, but I want you to think about what kinds of products would you look at only the incremental sales, and what kinds of products would you look at total sales, because your argument is somebody would have done this to me anyway. So let's finish this side costs and side benefits by talking about project synergies. And you know, Disney is a master at creating synergies, right? It produces a movie, The Beauty and the Beast, the live version of it is, I'm sure there'll be toys, merchandising, new TV shows, all kinds of stuff. So when you think about looking at a new movie that Disney makes, not only do you have to count the revenues, the profits, the cash flows in the movie, you also have to count all those side benefits you get from merchandising. If you get a chance, if you visit my blog and type in Star Wars, when I valued the Star Wars franchise right after The Force One came out. I think I came back from the movies and I told my family, look, I need a couple of hours, I have some stuff to do, because I was still fresh in my mind. I've been a Star Wars fan from the beginning. And I value the franchise. And you know what's left in this franchise is Disney owns it. And they've been very explicit about their plans for the next 6 years. They're going to come out with 3 Star Wars, including Force One, and 3 spin-offs. You saw the first of the spin-offs, Rogue One, but there are going to be 2 more spin-offs. So basically I projected out the revenues I estimate about $2 billion in revenues for the big Star Wars movies and about $1 billion on the spin-offs. And in the first 2, they've actually come very close. There were $2.2 billion on Force One and about 1.15. So basically I projected the revenues out and I came up with the cash flows from just the movies. But here's the thing about the Star Wars franchise. If you look at its history, for every dollar, and this franchise has been around since what, 1977. For every dollar that they've made at the movies, they've made $4.25 in all the additional stuff. There's a reason George Lucas created that universe with over 168,000 characters. If you're a toy merchandiser, your eye just lights up. That's 168,000 toys you can produce. $4.25 in merchandise for every dollar in revenue. So to value the franchise, I value the movies, but I also value the side benefits. I used history, $4.25. The value that I got for the Star Wars franchise was about $10.5 billion. And of course, Disney bought it for $4 billion. It's a great investment. The only better investment was the one they made in Marvel, where they paid $4 billion for Marvel. That franchise now is probably worth $16 to $20 billion. And that's not even merchandising. That's just pure movie rights. That's a movie machine in terms of hit after hit after hit. So when you think about synergies, that's what you're thinking about. But what I want to do is go back. Remember I did the Tata Motors Harman Audio merger, but I left it halfway. I valued Harman Audio as a standalone company. Let's assume that I want to do that as a synergy. But before I do that, I'll do a much smaller example. This is actually a cafe that bookstore is planning to add. So what should we add this cafe? So basically, here's what the numbers look like. Okay? If you look at the cash flows of just running it as a cafe, let's say you come up with a negative net present value. You project out the revenues, the expenses. So as a coffee shop, this project is a bad project. But then you say, if people come to the coffee shop, they're more likely to buy books in the bookstore. After all, that's why Barnes & Noble keeps those coffee shops. They're not interested in selling you just coffee. They want you to buy stuff in the bookstore. So let's assume that by adding this cafe, you increase revenues in the bookstore by $500,000 in year 1, increasing over time to almost $732,000 in year 5. The operating margins are given at 10%. I've projected out the income after taxes from opening this bookstore. So think of this as the synergy benefit, 30,000, 33, 36,000. And if you discount those, the present value of the synergy benefits you get from opening this cafe is 135,000. My net present value for the project without the synergy benefits is minus 87,000. The positive benefits I get from the synergies plus 135,000. If I've done my numbers right, adding the synergies to this project makes it go from being a bad project to a good project. Of course, you've got to be realistic about those synergy benefits, but this is where synergy benefits can tilt the scales. So let's go to the merger that I talked about, the Harman Audio merger. I gave you, I think the value that we came up with is $2.476 billion for Harman Audio as a standalone company. But let's say we start thinking about synergies here. And let's assume that by combining these two firms, here's what you hope will happen. You hope to upgrade your cars, and by upgrading the cars, it'll take about 3 years to do the upgrades. Starting in year 4, let's suppose you're able to generate 10 billion rupees in extra operating income, after-tax operating income every year in perpetuity, growing at about 4% a year. Because these are in rupees, I can use a higher growth rate. So here's what I get. I have a present value, the value for Harman Audio as a standalone company. I have synergy benefits that will start 4 years from now, $10 billion, growing at 4% a year forever. Let's value the synergy benefits. If you think about the cost of capital to use to discount these synergy benefits accrue not to Harman Audio here, they come from Tata Motors being able to sell more cars. I'm doing everything in rupee terms, so I'm going to use the risk-free rate in Indian rupees, so basically 6.57% becomes my risk-free rate. The beta that I use is the beta for car companies because I'm selling more cars, not more audio systems, so I use the business risk of the levered beta 1.10 for Tata Motors. And assuming these higher sales come from India, that's a big assumption because if it's Jaguar Land Rover that's doing the upgrading, I'd have to do what I did on the project and look at where the revenues come from. My cost of capital in rupee terms for this additional synergy benefit is 13.63%. I know it sounds like a lot of work, but synergy, you have to separate it from the rest of your cash flows. You have to think about the risk in those cash flows, come up with the cost of capital that reflects that risk. That's the discount rate I'm going to use to value the synergy. And the value that I get for the synergy, 10 billion growing at 4% a year forever, is 103.8 billion rupees. That is 4 years from now. So I discount it back to today. The present value of the synergy is about 70.7 billion. That's in rupees, right? If I convert it into dollars, that works out about 1.179 billion. That's a pretty large synergy. But if I add it to the 2,678, which I valued Harman at, the total value that I get for Harman is still way below the 5.2 billion that the company is selling for. Bringing in synergy makes my value higher, but not high enough to allow me to do the acquisition. So if you see a merger motivated by synergy, you have to put a value on the synergy. You can't just use it as an explanation. This is why I'm going to do the acquisition. And to value synergy, you have to estimate the cash flows from synergy, which means you've got to be explicit about where the synergy is coming from. Discount those cash flows back, just like you do a traditional project, and say, this is the value of synergy in there. If you're interested in looking at a more elaborate example of synergy, you remember in InBev bought SAB Miller, largest brewer in the world. This is a huge merger, one of the largest in history. And a lot of the talk around that merger was about synergy. So I have, again, a valuation of the synergy in that merger, much more messy than this valuation because lots of things are changing, higher growth, lower costs. But that's the template that I use here. It's a very simple template, can be expanded to cover any kind of synergy that you have in a merger. Okay? Any questions on synergy? If you work in M&A, though, it's amazing how often synergy gets used as a rationale for a merger, but nobody puts a number on it. It's there, therefore, it's okay to do the merger. I'm going to close off with something that I will not go into in detail because it requires some option pricing knowledge, and I don't want to kind of test you on that right now. But I want to at least talk about how optionality can change a project. When you think about traditional project, you take the cash flows, you discount them like I did for the Home Depot furniture, you come up with the net present value. You say net present value is negative, don't take the project. Net present value is positive, take the project. That's the way we frame capital budgeting. But when we do this, we're doing what's called a static analysis. The question we're asking is, today should I take this project? And the answer is, the net present value is negative, don't. But here's what you might be missing when you look at that net present value. The first is what I call the option to delay. Having the exclusive rights to a bad project can still have value. Why? Because even though the project has negative net present value today, it could have positive net present value in the future. That's why you might invest in a non-viable technology. If you think there's a chance that this could become a valuable technology, the net present value today is negative, but the value of the technology itself is positive. That's called the option to delay. It shows up in patents. It shows up in natural resource companies. The second is the option to expand. What does that mean? You have a negative net present value project. You think about investing in China. Your initial investment, and you're a hotel company, let's say you're Marriott. You look at a 10 hotel investment in China, you look at the cash flows, the net present value is negative. You're ready to reject the project, right? But let's suppose I add something on. I said, look, if you go into China and these 10 projects happen to do better than you expected, you have the exclusive right to open 100 more hotels in China. It's an option to expand. And especially when you talk about big markets, that option to expand can sometimes lead you to take a bad project up front, hoping that option to expand kicks off. And finally, there's the option to abandon. This is the option of being able to walk away from a mistake. So let's say you have a 25-year project you've taken. 3 years into the project looks like it's crap. Cash flows are coming in way below expected. In traditional capital budgeting, we act like you're stuck with the project, right? The cash flows continue. But what if you have the right to walk away? You built it into the project. You might have to pay something to walk away. That's called the option to abandon. Having the option to abandon can sometimes make a negative net present value project, especially a really long-term project, become a positive net present value project. Now, if you actually use option pricing, you can actually value these options. But rather than value the options, I just want to focus in on the intuition. Right? You've seen payoff diagrams for options, right, in foundations. What makes options unique is they have limited losses and unlimited profits. There's a floor on your losses. So this is the option to delay. Basically, you have a project that right now is a negative net present value. The initial investment on the project becomes like the strike price. If the present value of the cash flows on this project exceed that initial investment, you will take the project. If not, you'll give up whatever you paid to get the rights to this project. When you talk about the option to delay, you're essentially talking about a call option, and like all call options, they could become valuable or they might end up being useless. But what you lose is what you paid to get the rights to this project. As I said, this is actually something that is worth thinking about when you bid on a technology that right now doesn't work but could have value in the future, is you're buying an option to delay. You look at a patent. That patent might not be viable today, but it could be valuable in the future. So it's a reach in terms of using option pricing, but there are some kinds of projects where you could argue that the rights to a bad project are worth a lot, even though the project itself has a negative net present value. I'll tell you a story. In the early 1970s, RCA came up with this new product, and I'll describe the product, and some of you might recognize it, but though many of you might not, because you need to be of a certain age to recognize it. It was a box into which you put a tape, and you could watch videos on your TV. It was, of course, the first VCR. And actually, they did the capital budgeting when they developed it, and they concluded it's a horrible product. And here's why. They said, who'll buy a VCR? There's nothing to watch. It's not like you could go to the tape store and rent a tape. So their original capital budgeting was right. It was a bad investment then. But then they made their fatal mistake. So RCA said, look, this is a bad investment. Net present value is negative. Some guy in the finance department said, net present value is negative. It's worthless. They were approached by Panasonic. Panasonic said, we heard you have this bad technology that doesn't work. Would you be willing to sell it to us? And you can almost see people at RCA laughing behind their heads. Do they know the net present value is negative? So they sold the rights to the technology for $50 million. The rest, as they say, is history. 10 years later, everybody wanted a VHS, including RCA. But guess what they had to do? They had to go to Panasonic and license the rights to produce these VCRs, and they paid more per year as a licensing fee than they sold the entire technology offer. It happens because, and I'm not finding fault for them in hindsight. I'm just saying, look, I understand that the project was not, but don't jump to the conclusion that just because a technology is not viable today that you should be giving away the technology, because depending on the market that's out there, you could have the right to that technology still be valuable. That's your option to delay. The option to expand, as I said, is that second option. Your first investment is a negative net present value investment. And I like the example of the Marriott, again, to kind of illustrate this. You invest in the 10 hotels, your net present value is negative. You know it up front. It's a bad project. But by investing in this project, you get the right to expand into 100 more hotels. The cost of that expansion becomes the strike price. Of course, you will expand only if you believe the present value of the cash flows from expanding are higher than the cost. That's not true now, but it could be true in the future. And the bigger that second option is, the more likely it is that you will take the bad investment up front. In fact, I think this explains why companies are so willing to invest in China even though they know they're going to lose money. Many of them just see the size of the market and they say, look, there's an option to expand. Okay? That option to expand is valuable enough that can overcome that initial net present value being a negative number. Okay? So the implication here is when you look at a project, it's so easy to just look at the NPV and let it go. But if you get the right to expand, it's got to play a role. Let's now talk and this is the final piece of what we'll do. Let's talk about existing investments. So everything we've talked about now is for a new investment, right? Should I take a new investment? But you have lots of investments on the ground already. Let's take Disney. Forget about the Rio Disney. They have California Adventure, which is a problem for Disney. It's a problem for Disney. Have you ever been to California Adventure? It's in Anaheim. It's right across the walkway from Magic Kingdom, right? Magic Kingdom, the Anaheim Magic Kingdom, is the oldest Disney theme park. It's been around since 1958. California Adventure was built at a cost of about $1 billion maybe 20 years ago. And the original motivation was that, hey, you bring your kids to Magic Kingdom, but you might want to go on rides. So it's more of an amusement park time theme park. And they expected, when they built the California Adventure, that 60% of the people who came to Disney would cross over and go into California Adventure. That was the original motivation. The actual number has turned out to be closer to 40%, and Disney has struggled with that problem for 20 years. Because when you look at an existing project, you're not starting from scratch. It's not invest or don't invest. Your choices become richer in some way, but they're more difficult. So when you look at a project, often you look back in time, it's not so that you want to punish somebody. It's really because you want to ask, what do I do next? So let's separate the two. Let's say you want to first look at a project to see how it's doing relative to your expectations. So I go into Home Depot Furniture because you told me to go in. 3 or 4 years from now, I'm going to get actual revenues, actual expenses, actual cash flows, right? Then I can compare them to what you projected for those 4 years. When you make that comparison, here's what you're looking at. You're looking at the actual cash flows relative to forecasts, and you're saying, is this somebody's fault or is it just a mistake? And let me explain. The project I put up as the weekly puzzle this week, which I'm sure nobody's seen, is actually an investment that Chevron made in Australia in 2011 when oil prices were high. I've talked a little bit about this project. It's a $56 billion project that they took on. I'm sure there was a capital budgeting analysis done in 2011 based on oil prices then that showed great cash flows and a positive net present value. So if you go to 2016 and look back in time, the actual cash flows are way below those expectations because oil prices are down. And the question I asked in the puzzle, and I might as well throw it out here, should I punish those analysts in 2011 for coming up with cash flows? And the answer is, if the difference is the oil price, it's not fair to punish. It's not like the analysts were alone and thinking, the entire market thought the oil price should be 100. But here's the part where I can punish them. The other reason the project has become worse is the original cost that was estimated as the initial investment in the project was like $22 billion. The actual cost came in at $36 billion. That you can't blame oil prices on. That is just you underestimated the cost. So when you do a postmortem, the cash flows will always be different from your expectations, but you're also checking to see, is it somebody's fault, in which case you want to fix it, or is it just fate, things happening that you don't control. So that's the postmortem part, but here's the second part. You now are 3 years or 5 years into the project. When I ask you, should I keep going with this project, you can do new cash flows. You can act like this is a new project, project out new cash flows for the future, and those new cash flows are going to determine whether you continue with this project, shut this project down, or sell this project to somebody else. Remember, you have all three choices with most projects. So with existing projects, it's not a question of did I make a mistake. There's nothing you're going to do if you made the mistake in the past, but what should I do today? So when you do postmortem analysis, look at the differences between why your cash flows are different. So it's chance or bias, people screwing up on estimating cash flows. If it's chance, it's nobody's fault. If it's bias, somebody's got to be held responsible and something has to change in the system. But when you forecast out the cash flows, here's basically what your choice becomes. If your new cash flows looking forward are all negative, so basically it's 3 years in, you project out the cash flows, you conclude this is a shale oil investment, your cost for extracting oil is $65 a barrel, it's costing you, the price is only $55, then you shut the project down because your cash flows are all negative. If the cash flows are positive, but they're less than what you can make by salvaging the project today, terminate the project. Basically, shut the project down, get your salvage value. If there's somebody out there who's willing to pay you more than the present value of those cash flows, maybe ExxonMobil wants them, or Royal Dutch wants them, sell it to them. But if it's greater than zero and there's nobody out there willing to pay you any money, you might as well continue the project. It's less valuable than what you thought it was 5 years ago, but you can't fix the old mistake. It's the rationale I used to hold on to Valiant one last time. Right? I bought it at 32 and then it went to 14 and I bought more and now it's down to 11. I don't have to tell you that I've lost money on it, but at $11 per share, the question I have to ask is not did I make money or did I lose money? Of course I did. The question I have to ask is going forward, should I hold on? And it's almost like starting the process from scratch. The only promise, I have all those psychological things that I'm carrying, those sunk costs, the investments I've already made. But if you're acting sensibly, you have to be able to wipe out your memory and say, given what I know now and given what I'm forecasting for the future, what's the most sensible thing to do? So I told you the story of California Adventure. As you know, Disney has spent another $1.5 billion on California Adventure to bring it up. And in 2008, they had 3 choices with California Adventure because it wasn't working. One was they could have shut it down, but if they shut it down, it's, they can get back about $500 million. That's what because they basically converted parking lots that they used to own into California Adventure. The second is they can continue with the status quo. The status quo was the future cash flows are much lower than the original cash flows and use those. And the third is they had a choice of investing even more into California Adventure to bring the cash flows up, $600 million. They can shut it down, continue as is, or invest even more. You know what they chose to do, right? They invested even more. They built the Cars ride. Some of you have been to recently to Disney. They've added a lot of rides. They're trying to get the cash flows up. And if you think about that $600 million that they added on, it's got to be treated like a new investment. The question you got to ask is the incremental cash flow I'm going to get from investing that $600 million going to be greater? The present value going to be greater than $600 million. So all I'm saying is it's so easy to just think about capital budgeting for new projects, but I think it's even more critical that we take all our existing projects as companies and ask the question, what should we be doing about these? And the choices are, you either continue, you liquidate, you invest more, or divest. Basically decide what's right on each one. And that's what many activist investors force companies to do. They force companies to think about what they should be selling off, what they should be holding on to, and what they should be just shutting down. So let's close there, and when we start on Monday, we will start with packet 2. One other thing, I hate to pile on, but you know what's coming a week from today? The second quiz. That's the bad news. The good news is, if you worked on the case, and that's the if, the second quiz is all about the case. It's all about the things you had to do on the case. It's only up to the end of packet 1. So packet 2 will not be on the second quiz. It'll be all of the capital budgeting stuff. So review that stuff because that's what the second quiz is going to be about.
So I took your suggestion of brevity quite strongly, and there's some we didn't include our cost of capital calculation in our debt.
Okay.
Is that?
No, it's fine. I mean, it could look strange, but I mean, look first, you should tell me how you got it.
Okay.
Will you tell me how you got the cost of capital?
No, we didn't go through the procedure. We just basically I did it in a PowerPoint deck, so like making highlights. Okay,
So what did you say about the cost of capital?
Not much actually.
So you just said the cost of capital is
Right.
percent.
Right.
why don't you send me an addendum as to how you do the cost of capital?
Okay. Okay. We did it quite.
Because you can do it in a bullet point, but if you said we got the cost of capital by looking at the unlevered beta for furniture stores, I'm okay with it. But if you did not do that, then at least send that to me.
When you mentioned real growth rates in terms of capex investments, I wasn't exactly sure what you meant by real growth rates.
It's a growth rate greater than inflation.
So is that something that we come up with, or like, is it?
So if you use 3% instead of 2%, so 1%
I was
real
kind of
growth.
confused between like nominal and real growth or cash flow growth rates. So.
Nominal is inflation. Right? Anything above inflation is real. Right? So basically that's extra growth, in which case you got to build more capacity. Right? That's what I said. If you set the growth rate above the inflation rate, then you got to build in investments to increase the capacity, not just maintain it.
And secondly, I know for the Home Depot case, it probably didn't make much of a difference, but we're calculating the equity risk premium, and in this case, it was forecasted that they were going to add additional stores in the future, but only 10 stores per year. So
You could do the equity risk premium.
so
Change over time.
it could change over time, right?
I noticed that you made all the new distribution capacity investments to the new application.
Incremental cash flow. Incremental cash flow, there's no allocation. The company spends the money. The company spends the money for negative cash flow. They don't spend 1/5 of the money, they spend the entire amount.
Yeah.
So I'm not sure what you were doing, Scott.
Actually, I made an assumption that I separate the two businesses.
No, but I'm saying it doesn't matter. Ultimately, only the company can spend the money. You can't say 20% belongs. That's an accounting. If you're doing an accounting allocation, you can do that. You can say this project uses only 20% of the distribution, so I'm going to allocate 20%. On an accounting basis, that makes sense. But from a cash flow basis, it makes no sense.
But you know, I just separate the two
You
businesses.
can't, it doesn't matter. There's only one place cash flows come from, the company, stockholders. Separating into two businesses means nothing. You're taking money out of my left pocket and putting it in my right pocket.
But when I evaluate the new business, it's totally different result from.
No, you're missing the point. Who's investing the money in the new business? The stockholders. Right? So the fact that I'm spending in one business as opposed to the other doesn't matter to me. All I'm looking at are incremental cash flows to those stockholders. And basically to them, the entire amount you spend in year 6 is a cash outflow because of the project. But that's the way you bring it back to steady state, is you look at also the savings you do. And that's why you have to bring in the savings. Is you have to look at the savings, because that's what I save as a company in year 12. This business is not saving 643 million, but the company is saving 643 million. So when you talk about incremental cash flows, even talking about allocation is inconsistent with the notion of a cash flow. You have to basically take the entire cash flow. So you can't allocate a portion of it to one business and say that's my cash flow. It's not, right? Because cash flows are cash flows. Right?
And another question, sorry, about I actually I didn't catch you about the capital leases. Why you didn't include?
No, I did include them as debt. I did include them as debt, yeah. Because there is an interest expense that goes with them, so they're like conventional debt.
Yeah.
The items I did not include were non-current liabilities because they don't have an interest expense with them. And I think it is accounts payable and supplier credit are not included because they're non-interest bearing. The minute you have an interest expense, it's debt.
And when we doing the homework and we have a discussion on the capital lease, because
Once it says capital leases, you have to treat it like that. Because what accountants have done with capital leases is they did what you did with operating leases, treated as, brought it into debt, and they've increased the interest expense by that amount.
But I think we didn't get the number in 2017. We only have the number of capital lease in 2016.
But I could say the same thing about regular debt, right? You have only from 2000. Why would you need it in 2017? You're saying between December 31st of 2016 and March it could have changed? I could say the same thing about all debt. So why is this just to our capital leases? It would be true for your interest-bearing debt. In fact, it's going to be a bigger issue for your interest-bearing debt than for leases, right? Who knows what that amount is as of today? They might have borrowed more money or repaid a big loan. So it's not just capital leases. Any accounting item, you're going to have that issue because the most recent accounting time period. And that's why I spent a little time on that time.
Yeah.
right? Accounting time, real time, and you know, and business time all work on these different cycles, and you got to work with what you have. Yeah. Yes.
A quick question on the entire semester project. It's my understanding that we're supposed to divide up our business into basically business segments. And
To get the data.
and then we're basically finding comparable companies to those business segments. Should we just, I use Capital IQ, so should I actually expand that list so that it includes enough businesses from the business segments? Because my business segments are very similar.
What are they?
So I'm doing Delphi, automotive, and so they have basically electronics that go into the car itself.
They're all auto parts, basically. I would just use auto parts.
So
It's a single business.
That's it. Okay, thank you.
Yes.
I was trying to pick up on first Chris last week. Is it true that it didn't pick it up?
I have it in my office.
And then my score won't count?
What? No, that's not true.
It's not true. So my score will count.
Yeah, of
So,
course. If you want it discounted.
okay, thank you. Appreciate it.
Hey, how are you? So there was a difference in the groups. I was initially working with one group,
Yeah.
and then I had to switch group because of the theme of that woman fit. So I think there will be two submissions.
With your name on
my
it?
name on it.
So
But the
which
one
one?
that I sent, that should be
Okay.
roughly.
So just send me an email
I
telling
will
me the
send
other
that.
group that you're in
Yeah,
too. So,
yeah. So told them last evening, and I work with both the groups, so mostly I should be the same across the groups.
I had a question about ROIC calculation. So the way I calculated